The Dow surging 464 points to a record close, and the rotation away from growth stocks continued yesterday. Check out just how far the Dow has come since March 11th of last year, when the WHO declared the pandemic. It's been a year, and you could see the markets drop leading up to that day, and then what's happened since. It's been kind of phenomenal. The Dow up 27%. Joining us right now is Jeremy Siegel. He's professor of finance with the University of Pennsylvania's Wharton School. And Jeremy, you've got a really interesting take on what comes next. We just have this stimulus bill that passed. What do you think that leads to?
I think that's more fuel on the fire, so to speak. Last night I went, ate in a restaurant inside, the first time in a year. More and more people are going to be doing that. It was a great feeling. There's this pent-up demand. I think this economy was going to do great before this bill, and now there's more money. But particularly, I pointed out for 9 months how much money, record amount of money in the system that's got to go to financial assets, and I do believe much higher inflation and higher interest rates. But I think stocks will be able to surmount these higher interest rates, even though there will be pressure on the Fed. Hey, when are you going to start to slow down this higher inflation? But the Biden administration wants this economy to run hot, and there'll be a lot of political pressure to let it do so.
So let's break that down a lot of different ways, because to this point, Jeremy, a lot of people have thought if bond yields rise, that is going to mean that stocks will go down, that bonds will look more attractive as a result. Tepper said he thinks there's going to be a cap on bonds, but that's a separate story. Let's just say you all get to the same conclusion. You think stocks are the place to be, but you think bonds are going to rise too. Why do you think that stocks will stay attractive in that environment?
Well, let's assume bonds go to 2.5 or 3. Yeah. If in an environment where we have a 4 or 5% inflation, which I really think is going to happen, that's still not attractive at all. Remember, stocks are still real assets. They're claims on real capital, real ideas, copyrights, intellectual property, etc. They're going to maintain their value in an inflationary environment. Dividend-paying stocks, dividends go up with inflation. Bond yields, if bond yields are rising, you take a double hit you have less purchasing power on the bond, and the bond price falls. So we can't take advantage today of a bond yield 3% a year from now. It actually makes the bond market that much worse compared to stocks. And that's why the money, I think, is going to continue to flow into the stock market.
So you think the stock market is being short-sighted when they look at higher yields and start thinking, okay, the comparison here, maybe that's more attractive? You think this is just a short-term, short-sighted sort of move? How long are you looking down the road before the market figures this out? Well,
eventually there will be a Fed tightening. And eventually, that tightening is going to pressure stocks. And that fear of that, I think, is beginning to come through now. But when I see the amount of stimulus come, I can see another 10% rise in stock prices, 10, 12% this year. Then the Fed gets more worried, and a leveling off 2022, 2023. But we're still in the phase where the liquidity is going to push stocks over. We're going to get those little, fears that are coming through, but it's going to be overwhelmed, I think, by the strength of the economy and the rise of corporate earnings.
Shepard Smith here. Thanks for watching CNBC on YouTube.